Volume and price, how to know when real money enters the market. Introduction. You don't lose because you picked the wrong stock. You lose because you don't know who is actually trading behind that candlestick. The market always speaks to you, but not with words. It uses only two tools, price and trading volume. If you only look at price, you're hearing just half the story. But if you know how to combine price with volume, you'll clearly see where the money is flowing and who is truly in control of the game. The question is not, will the price go up? The real question is, who's buying, who's selling, and are they really strong? In this video, you'll learn how to read the footprints of big money. Not through gut feeling, not through rumors, but through the logic of those who never follow the crowd, the smart money. Stay with us until the end, because once you understand the language of the market, you won't need to guess anymore. You'll act in alignment with those who truly control the game. Chapter 1. Understand volume correctly. High volume doesn't always mean strength. In technical analysis, volume is often seen as the footprint of money flow. But most investors read volume incorrectly or not deeply enough. They see high volume and assume big money is entering, or see low volume and assume the market is weak. This way of thinking is too simplistic and sometimes extremely dangerous. Volume only has meaning when placed in the right context, especially when combined with price action. In other words, you can't separate volume from the price chart and expect an accurate answer. Volume is not money flow, it's the action of money flow. Volume simply shows the number of shares traded in a session. It doesn't tell you who's buying, who's selling, whether they're strong or weak, or whether it's real money or just fake volume from big players dumping onto retail traders. Example, if a session has very high volume but the price drops sharply, that's not buying pressure. It could be smart money exiting while retail investors rush in out of FOMO. The volume is large, but it's not strong money coming in, it's smart money distributing. On the other hand, a session with moderately rising volume and a close near the high of the day, especially after a period of sideways consolidation, could signal smart money starting to enter quietly. These subtle sessions are often the starting points of major uptrends. Volume is rising, but how does price react? The key is the price reaction to rising volume. If volume increases and price rises strongly with a close near the high, that's a good signal. Real buying strength, sellers can't resist. If volume increases, but price only edges up or shows a wick, that's a warning sign. Selling pressure still exists. Buyers haven't fully won. If volume increases and price drops sharply, chances are smart money is offloading while retail traders are being lured in. Volume becomes valuable only in context. What stage is the market in? Is the stock in accumulation, advancing, or distribution? Quiet accumulation, when smart money begins to appear. One of the most valuable signals is gradually rising volume during accumulation. Imagine a stock moving sideways. Price doesn't rise much, but volume is slowly increasing day by day. No fireworks, no sudden spikes. Just steady accumulation. That's how big players quietly accumulate. They don't want to leave clear footprints. They accumulate bit by bit, enough to avoid pushing the price up too fast, but still take control of supply. When this process finishes and they flip the switch, you'll see a breakout candle with big volume. But if you wait until that breakout to enter, you might be stepping in just as they're preparing to take short-term profits. Low volume isn't bad. Sometimes it's a positive signal. Many people think low volume means a stock is being ignored, but during consolidation or pullbacks, low volume can signal selling pressure is fading. When a stock pulls back and volume gradually dries up, it means sellers are exhausted. There's little supply left at that price zone. Even a small surge in buying can push the price back up. Once you understand this, you won't fear those quiet pullback sessions. You'll start to see opportunity where others hesitate. In summary, volume must never be viewed in isolation. It must be combined with price action and market context. High volume doesn't always mean strong money is entering. You must analyze whether it's buying or selling. Low volume during accumulation or correction can be a positive sign. Smart money doesn't rush in. They accumulate gradually and only appear clearly once they've taken control. Chapter 2, Pattern 1. Rising volume, but no price increase, the most common trap. Many investors, especially beginners, often called F0 investors in Vietnam, get excited the moment they see a trading session with a spike in volume. They open their trading screen, notice a sudden surge in liquidity, volume doubling or tripling the average, and immediately think, big money is coming in. I have to jump on board now. But this is one of the most familiar traps in the market. Rising volume with no price increase is an extremely dangerous pattern if you don't understand the logic behind it. It often signals that the smart money is quietly selling, while retail investors are enthusiastically buying in. Why does volume rise but price stays flat? Imagine this. If a large amount of money flows in to buy a stock, the logical outcome should be that the price goes up. So why are there sessions where volume soars, but price moves sideways or even closes lower? The answer lies in the sellers. In these situations, selling pressure from institutions or major holders is carefully calculated. They know the retail crowd is getting excited. They allow the price to rise slightly at the beginning of the session to trigger FOMO, fear of missing out. Once volume starts to spike, they quietly start selling. Not aggressively, but just enough to absorb all the buying pressure. The result, volume rises, but the price fails to break resistance, fails to close high, or worse, pulls back sharply, leaving a long upper shadow. This is a classic distribution pattern, not accumulation. Clear technical signs of this pattern. Volume spikes sharply, well above the 20-day average, sometimes 2 to 3 times higher. Price only rises slightly or struggles during the session, closing below key resistance or far from the session high. The candle is often a small-bodied candle with a long upper wick, sometimes a doji or gravestone doji. It usually appears after a hot rally or right at a strong resistance zone. This is how the market deceives you with volume. Real example, the October trap. Imagine a real estate stock that has been on a strong uptrend in October. After 5 straight bullish sessions, the price enters an old resistance zone. On that day, volume explodes, double the average of the previous 10 sessions. Retail investors cheer. It's about to break out. But the price only rises 1%, then pulls back sharply near the close, finishing below the opening price. A long upper shadow, massive volume. 3 days later, the stock drops 15%. If you don't recognize this pattern, you might think, it's just a pause, let's buy more tomorrow. But if you understand it, you'll see, this is a signal that smart money has sold, and they've already won. The psychology behind the pattern. Smart sellers are taking advantage of the crowd's greed to unload at a good price. Inexperienced buyers only look at volume, ignoring price behavior, and walk right into a short-term top. The whales never announce, "I'm selling now." They use volume and price action to create the illusion of strength right before they exit. By recognizing this pattern, you'll stop buying at short-term peaks and avoid the bull traps the market sets daily. Confirmation signals after this pattern. After a large volume candle with no price increase, following sessions show weakening price action while volume declines. If the price breaks down past the nearest support level, the distribution pattern is confirmed. Smart investors won't buy. They'll either stay out or start planning their exit if they're already holding the stock. Conclusion: rising volume isn't always good. When volume spikes but price doesn't rise, be cautious. This is one of the most common distribution patterns in the market, and also one of the most misunderstood. When you see rising volume, stop and observe price action. Don't rush in like a moth flying into the flame. Chapter 3, Pattern 2, Volume surges, price breaks out of accumulation zone, big money has entered. There's a pattern that every professional investor keeps an eye on. It's not loud. It's not flashy. But when it shows up, it signals the return of big money, the real players stepping in. It's when volume spikes and the price breaks out decisively from a prolonged accumulation zone. No longer are we dealing with short-term speculative waves. This is the signal of a new trend about to begin. Accumulation, the launchpad for price. Before a breakout happens, the market often enters a sideways phase. Flat, boring. Price fluctuates within a narrow support-resistance range for weeks, even months. Volume dries up, liquidity shrinks. Retail investors get bored and leave. No one's paying attention. But it's exactly in that silence that smart money quietly accumulates. They're not in a rush. They wait patiently for the market to grow dull, for retail holders to get shaken out. Then they slowly build positions, keeping the price steady to avoid drawing attention. Then one day, volume suddenly surges, and price breaks out of the accumulation zone, punching through resistance decisively. That's the signal. Big money has activated the breakout phase. Key technical signs of the pattern. Price has moved sideways for several sessions, typically over 3 to 6 weeks. Narrow trading range with gradually declining volume, showing supply absorption. Suddenly, a session with volume explosion and price breaking past resistance, closing at the day's high. No pullback wick, no upper shadow, indicating strong and decisive buying pressure. This is a true breakout, not a trap. Real case example, steel stock late Q2. In mid-June, a major steel stock had been accumulating in the 17 to 18 range for over a month. During that time, volume kept declining. Retail investors gave up, believing the stock was done. But on June 28th, volume exploded, tripling the 20-day average. Price broke out of the 18 level and closed at 18.9, near the session's high. The next day, the rally continued. Volume remained elevated for 2 to 3 sessions. That was the moment big money stopped hiding. They had officially entered. Over the next 3 weeks, that stock rose more than 25%. Why is this pattern reliable? Because it reflects a well-organized shift in market state. Before, market is dull, retail investors exit, price moves sideways. Smart money accumulates quietly. When accumulation is complete, they use large buying power to break price through resistance, beginning a new uptrend. There is no real breakout without significant volume, and no sustainable breakout without a solid accumulation base. Entry point for smart investors. Don't enter too early during accumulation. Wait for the breakout confirmation. Enter right after the breakout session with high volume, if the price closes above resistance without a pullback wick. If you missed the first breakout day, wait for a retest of the breakout zone, but only if confirmed by low volume and returning demand. Investor psychology at this stage. Retail traders are still hesitant. They remain skeptical. Big money has already entered. They don't need to hype it. They've prepared in advance. Those who recognize this pattern will act quietly and profit from a strong, sustained trend. That's why many say, you don't need to be smarter than others to invest, just more patient. Beware of false breakouts. Not every breakout is real. Here are 3 things you must check. Is there a long enough accumulation base? No base, high risk of a bull trap. Is the volume breakout clear? If volume is weak, be suspicious. Did the price close strongly? If there's a pullback wick or no clear breakout, don't rush in. Conclusion. This is one of the clearest signs of big money entering. Rising volume plus price breaking out of an accumulation zone. You don't need to buy at the bottom. You don't need to guess the bottom. Just buy when money is really flowing in. Train your eyes to spot clean breakouts, and you'll see that investing is no longer a game of luck. In Chapter 4, we'll explore a more subtle pattern. Price rises, but volume falls. When is it a danger signal, and when is it a contrarian opportunity? Chapter 4, Pattern 3. Price rises while volume drops, opportunity or trap. There is perhaps no market pattern more confusing to investors than a rising price accompanied by decreasing volume. At first glance, it seems positive. The price is going up. But when volume doesn't support it, what's the point of the rise? This is a classic case of a fake rally with no real money, a soft but sharp trap. However, this pattern is not always negative. In rare situations, it can be a psychological anchor point before a major breakout. The real challenge is, How do we read it correctly? When is this pattern a trap? After a hot rally, price continues to rise, but volume dries up. This often occurs at the tail end of a bullish wave. When the big money has already exited, retail investors, driven by the fear of missing out, FOMO, rush in and push prices higher. But without real buying power, the rise lacks support. A single wave of selling can crash the price hard. Clear signs. Volume steadily declines over 5 to 7 sessions. Prices inch up with small candle bodies, often showing upper wicks. No confirmation from volume, no clear breakout sessions. This is when smart money has already exited, leaving behind hopeful latecomers clinging on. Real-world example, real estate stock in November last year. A mid-cap real estate stock surged over 40% in just 3 weeks after positive interest rate news. From its peak at 21.5, the price crept up to 22.3 over the next 5 sessions, even as volume dropped day by day. On the 6th day, volume spiked, but due to selling pressure, the price was slammed down to 20.4 with a long red candle. Within 3 more days, it fell to 18.7, wiping out all recent gains. Lesson: if volume doesn't support the rise, the uptrend is just a trap for the impatient. When is this pattern an opportunity? On the other hand, there are moments when price edges up and volume fades, not due to distribution, but because big money is patiently waiting. This is the ascending base accumulation model, where the price no longer drops sharply. Volume decreases because sellers are drying up. Minor dips attract light buying interest. Then suddenly, after a quiet accumulation, volume explodes and the price breaks above recent resistance. That's the moment when big money quietly re-enters. Real-world example, tech stock in early Q1. A tech stock had a strong rally in early January, then stalled around 37 to 38. For nearly 2 weeks, the price edged up slowly while volume declined. Investors thought the trend was over. Then on January 20th, volume doubled and the price broke past 39 decisively. That triggered the next rally, taking the stock to 45 in under 10 sessions. Bottom line, price rising on lower volume is not bad if it's happening within a base. Price range is tight with little wick rejections. There's no sign of prior distribution. How to distinguish real versus fake rallies in this pattern. Signal rising price with falling volume is a trap. Rising price with falling volume is an opportunity. Context after a strong rally, near a peak after a mild run-up, within a base. Candles small bodies, long upper wicks short green candles, no shadows. Volume steadily drops, no breakout spikes gradually decreases, followed by a supply test. Selling pressure sudden and strong, virtually no heavy selling. Market sentiment euphoria, FOMO boredom, skepticism. Action plan for investors. Never chase rising prices when volume doesn't confirm the move. If you suspect it's an ascending base, monitor volume and the nearest breakout zone. Be patient, only enter when volume confirms the breakout. Don't catch falling knives or chase the peak. Investor psychology at this stage. Retail traders think price is rising and rush in. The wealthy watch volume, and do nothing without real signals. The patient are the ultimate winners. Conclusion: a rising price with falling volume is a double-edged sword. It can signal weakness or calm before a bullish storm. The key lies in context and your ability to distinguish distribution from quiet accumulation. Chapter 5 will dive into one of the most deceptive patterns. Volume increases, but price doesn't follow. What looks bullish could actually signal money quietly flowing out. Chapter 5, Pattern 4. Volume surges but price stagnates, real money flow or market manipulation. One day, you open your trading screen. A familiar stock suddenly shows trading volume 3 to 5 times higher than average. But the price barely moves, or just ticks up slightly before closing flat. If you look at volume alone, you might exclaim, "Big money is coming in. It's about to explode." But wait a second. When volume rises but price doesn't, that's not necessarily a sign of smart money entering. Quite the opposite, it may be the moment when big money is quietly exiting. A seemingly positive sign that's actually a trap. This is one of the most dangerous patterns for inexperienced investors. It creates the illusion of market strength, drawing people into a trap called volume trap. Key features of this pattern: sudden spike in volume, sometimes several times the 20-day average. Price fails to break resistance or forms candles with long upper wicks. No clear leadership or confirming breakout sessions. Put simply, a lot of trading activity, but no one's pushing the price higher. Reason 1: smart money distributing quietly. Big institutions or investors never dump shares all at once, not without buyers. They create an illusion of optimism, making the stock appear attractive so that retail traders buy in. The volume spike is due to disguised selling, with large orders split into smaller trades. As retail buyers think smart money is buying, they rush in and end up absorbing the shares smart money wants to unload. Real example: steel stock in March. A leading steel stock rose sharply from 13 to 17. Mid-March, the stock showed several high-volume sessions. On March 14th, volume doubled, but price rose just 0.2, closing nearly flat. Over the next 3 days, volume remained high, but the price couldn't break past 17.5. On March 18th, the stock plunged to 16.2, then continued falling to 14.5 over the next 7 sessions. High volume doesn't always mean strength. Sometimes, it just means a change of hands. Reason 2: fake supply to absorb weak hands. In some rare situations, high volume with sideways price can mean accumulation. This is a pattern known as reaccumulation, when a stock takes a breather after a strong run-up. Smart money doesn't want to push the price up too soon. It attracts attention and triggers resistance. So they quietly place matching buy-sell orders in a narrow range, keeping price flat while absorbing weak selling pressure. How to tell the difference: distribution versus absorption. Signal volume equals distribution volume equals absorption. Price action fails to break highs, upper wicks flat movement, minimal volatility. Candlestick small red candles, long upper tails, small green candles, short wicks. Volume sharp spikes, unsustainable steady, elevated volume for days. Trading range near previous highs inside a base or consolidation zone. Outcome sharp decline breakout when volume rises again. What to do when you see this pattern? Never act based on volume alone. Always compare volume with price action to understand what the money flow is really doing. If you suspect accumulation, watch the sideways price range. Wait for a strong breakout with high volume and price exceeding recent highs. If you suspect distribution, avoid chasing the price. Set a stop-loss alert if price fails to hold support. The psychology behind this pattern. New investors see rising volume and get excited, thinking a big move is coming. Smart money, meanwhile, quietly studies the disconnect between price and volume, revealing the real sentiment hidden beneath the surface. Reflection question for the chapter. If volume is the voice of money, are you really listening or just being distracted by noise? Conclusion. Volume is a powerful tool, but if you don't pair it with price action, it can deceive you. You might think you're spotting an opportunity when in fact you're walking straight into a trap. In Chapter 6, we'll learn how to combine volume, price, and candle patterns to pinpoint when real money enters the market through powerful setups like false breakouts, true pullbacks, and shakeouts before liftoff. Chapter 6, Combining Volume, Price, and Candlestick Action. How to spot real institutional money flow. A smart investor never looks at the chart in isolated pieces. They see volume, price, and candlestick action as three layers of a single language, telling a clear story of big money's intentions. In this final chapter, you'll learn how to connect these three technical elements into a powerful map, helping you detect when real institutional money is stepping in, so you can act before the crowd does. Part 1. The Power of Confluence. Strength lies in agreement. Real money leaves obvious footprints, but not in any single indicator. It shows itself in the confluence of explosive volume, but only in the right context. Price breaking out or holding a strong base. Clear, decisive candles, no hesitation. When all three signals align, that's when the market truly shifts phases. Part 2. Real money flow patterns. Pattern number 1. Confirmed breakout, not a fake out. Volume spikes well above the 20-day average, with price breaking above clear resistance. Candlestick, large green body, closes near the high, with small wicks. Psychology behind it. Big money is willing to buy high to break through consolidation, showing confidence and urgency. Remember, a true breakout always comes with strong volume and a strong candle. If a breakout happens on weak volume, be suspicious. Real example. A power sector stock in early April. After 2 weeks of tight consolidation between 19 to 19.3, a powerful breakout candle appeared on April 4th. Volume was 2.3 times the 20-day average. Long green candle closed at 20.2, then rallied to 23 within 5 sessions. Pattern number 2, pullback is an opportunity, not a weakness. After a breakout, Price pulls back to retest the previous resistance, now support. Volume drops during the pullback. Then, a strong green candle appears with rising volume, confirming demand is returning. A successful pullback is a test of real money. If institutions are in control, they will defend that price zone. Pattern number 3, shakeout and reversal, a handshake from big money. Sudden sharp drop, price breaks support. But volume spikes, and buying pressure pulls price back up by the close, forming a long lower wick. Next day, if a strong green candle appears with sustained volume, this confirms that big money just flushed out the weak hands. This is a classic tactic by smart money. Shake the tree, scare retail traders into panic selling, then quietly scoop up cheap shares. Part 3. Think like an analyst. Reading volume and price isn't enough. You must place them in context. What phase is the stock in? Accumulation, uptrend, or distribution? Is there a fundamental story supporting it? Is the flow consistent across the entire sector? Technical analysis is not just drawing lines. It's interpreting market psychology. Those who understand crowd behavior will act differently from the crowd. Part 4. The final lens, turning data into decision. Remember this. Volume is the voice of money. Price reflects expectations. Candlesticks reveal the battle between supply and demand. Once you learn to connect these three, you'll no longer wait passively for news or be swayed by temporary emotions. You'll see where real money is quietly stepping in, and you'll be ready to move with it. Final question for you. Do you want to be the one chasing the money, or the one who spots the clues and gets ahead of it? End of chapter. You've just completed the journey into the powerful combination of volume, price, and candlestick action. This series didn't just teach technical tricks, it opened up a strategic mindset to help you think like a true analyst. If your view of the market has shifted, even just a little, share this video with someone who needs it. And don't forget to subscribe to Bold Steps Forward, because bold moves don't begin with blind action. They begin with insight that rises above the crowd.